Hey everybody, my name's Joe Pivarunas. I'm the founder and managing editor of Nanalyze. We're a boutique media and research firm covering disruptive tech for a broad audience of retail and institutional investors across the globe. Today we're going to talk about a company called UiPath. And the title of this slide is a bit of a clickbait title. It says, "Why is UiPath stock dropping like a rock?" So I wanted to explain briefly why we chose these sorts of clickbait titles. And it relates to loss aversion. So investors are likely to feel the pain of loss twice as much as they feel the joy of gain. So a stock price can go up for years, thousands of percent, but as soon as it falls 10%, everybody panics and runs to the Ministry of Truth to try to figure out what happened. So you can see here, if we plug in "why is UiPath stock" into Google, all these searches that people do relate to the stock going down or falling or dropping. So that's why we chose the title. Now, in fact, the stock has been dropping, and this chart shows you the performance of shares over time. On the far left, that would be when the stock started trading. About a year ago, they had their IPO. The blue dot that you see, that reflects the price that the IPO was priced at initially. And then what it begins trading at is different, right? And then on the far right, you can see where it sits today. So the closing price as of last trading session was around $17.83 a share. You can also see that volume spike there on the right-hand side, the little white line, and we'll talk about that as well. Now, before we start to talk about a stock price underperforming, we need to quantify that and say, all right, relative to what? And the way that works usually is you pick a benchmark. And a lot of firms will use NASDAQ as a benchmark for tech stocks, but we've used the New York Stock Exchange because that's where UiPath trades on. So while UiPath sunk 75% over the past year, the New York Stock Exchange as a whole only dropped about 5%. So that tells us that something is going on specific to UiPath. Now, I just wanted to touch briefly on this concept of beta because it's useful. So we don't have a beta number for UiPath because it hasn't traded long enough, but you'll often see companies have a beta number. And a beta of 1 simply means that the stock moves in unison with the benchmark. So if the market falls 10%, a beta 1 stock will fall 10%. Now, a lot of value stocks are low beta. That means if the market falls 10% and you have a beta of 0.5, the stock will only fall 5%. And conversely on gains as well. So if the market rises, then the beta reflects the extent to which the stock will rise. And then you have volatile tech stocks, which are usually high beta. So when the market falls 10%, then a beta 2 stock might fall 20%. So we need to take that into account when we're looking at benchmarks. But still, when you see the NASDAQ or the New York Stock Exchange falling 5% over the past year and UiPath falling 75%, that's more than just beta. Now, one thing we can consider is that perhaps UiPath was overvalued to begin with. And this chart here kind of implies that to be the case. So you can see here we've shown, let's just move from the right to the left. So on the far right, you see the current valuation of UiPath today under a $10 billion market cap. Then to the left of that, you see a venture capital round that was closed about 3 years ago. That was a valuation of, say, $6 billion. And then in July of 2020, there was another VC round closed at a valuation of $10 billion. And then suddenly it jumps in February of 2021 to close to $35 billion. And when the IPO was actually priced, it was under that number. And then on the first day of trading, it was, look, about $37 billion. Well, it could be that venture capitalists got a little bit too excited about the robotic process automation theme. And we haven't talked about what UiPath does. So if you don't know, I'm going to put a couple articles in the description of this video so you can bring yourself up to speed on topics like robotic process automation and hyperautomation and the sorts of things that UiPath does. Now, another thing we can look at for this company is this notion of a simple valuation ratio. That's something we use here at Nanalyze to value companies, and it takes the market cap and divides it by annualized revenues. That's simply last quarter revenue times 4. So you can see here we've picked out of our tech stock catalog a number of names that we can use kind of as a relative comparison. And you see UiPath there in the middle with a valuation ratio of 8. And based on the rest of the names that you see here today, we wouldn't consider this stock to be overvalued compared to its peers, nor would we consider it to be undervalued. And by the way, Microsoft, which happens to be a big player in robotic process automation, has a valuation ratio of around 10. So take that for what it's worth. Now, about a month ago, we issued an alert to premium subscribers when the stock price dropped 28% in a single day. And what had happened is they reported fiscal 2022 revenues. They actually beat expectations, but they warned on the effects of the war on their European business. And we're going to talk about that. And they also reduced revenue guidance for fiscal 2023 of around 4.9%. That's a very small number, and it's certainly appropriate for them to do that. Quite surprised why the market reacted the way that it did. There was a 28% drop in share price, and we took that opportunity to top up our position in UiPath. We happen to be long, but we've already allocated the maximum amount of money that we have for that position, so we won't be adding at any price going forward. But later, we'll talk about why we think shares are fairly valued at any price where they're at today or below. So if we look at that Europe conversation, so you can see here that, first of all, the European exposure for UiPath is going down over time. You can see that if you read it from right to left. As of 2022, let's say fiscal 2022, 29% of their revenues came from Europe, Middle East, and Africa. So that's very common for international firms to refer to EMEA, which, while most Americans might think that Europe is a single country with a capital named Paris, it's actually 44 countries. And then when you consider Middle East and Africa, you have a total of 115 countries. So they don't give us a breakdown of what that looks like in terms of which countries they have exposure to, but we can see that less than 30% of the revenues come from EMEA. Now, we'll talk a little bit later about some other risks pertaining to Europe and UiPath. Now, before we do that, I wanted to post this picture. It's quite funny. Somebody had posted this in a very heated conversation about what's going on in Europe, and they said this is a non-political photo of a pigeon. And it's quite funny because it just shows that no matter what you do, you're dragged into politics when you start talking about topics like what's happening in Europe. So let's talk a little bit about that very quickly. It's the brown bear in the room, right? It's Russia and Ukraine and what's happening in that region. Now, in yellow highlight, you can see Kiev in Ukraine. That blue X, that's actually where I'm at right now. I'm in Chisinau, and that's in Moldova, about 40 miles away from Transnistria, which is currently the topic of a lot of media discussions based on some FM towers that were taken out last week, or actually, I believe it was this week, and some turmoil that seems to be happening in that breakaway region. It's all very interesting. And there's a lot of talks about how maybe Moldova will join with Romania. So an interesting side note there. Everybody will say they speak Moldovan. Well, Moldovan and Romanian, those two languages are pretty much the same. So there's some politics associated with that. And then the red cross that you see there, the red X, that's Bucharest in Romania, where UiPath has about 24% of their employees. So let's say something kicks off in Transnistria, and they're fighting to try to capture that. And then all of a sudden, Moldova joins Romania, which doesn't seem likely because the Moldovans they're not really interested in that. So suddenly, Romania is dragged into the war, and that's going to have an effect on UiPath in a number of ways, right? We don't know what could possibly transpire, but certainly if something kicks off, then it will be affecting UiPath more so than companies that perhaps don't have a corporate office in Romania with 24% of their employees there. So just wanted to make a note on that. Now, let's talk about the health of UiPath's business. This is quite important. So as shares continue to slide, we want to check into our thesis and say, well, how are things looking? Things couldn't be looking better. So this firm uses a concept called what we refer to as annual recurring revenues. They refer to it as annualized renewal run rate. They're the same thing. I'll put a link to an article we wrote that describes how we look at SaaS businesses and how we look at these metrics. But this was pulled from the 10K, and honestly, this is about all that you need to keep track of. So the top number there, that's different from revenues. I'm not going to get into why that is, but think about it like this. If everything froze and the clients that they had continued paying them the same amount of money, this is how much money they'd bring in every year. So close to $1 billion. That can be different from revenues because revenues reflect the actual cash that they're taking in. So it's an important distinction to make there. And even our best analysts sometimes get confused between the two. But if you read that article that I'll put in the description, you can see that it's really quite simple. Now, when we talk about ARR coming from individual clients, you can see here, you want to pay attention to the number of clients paying them more than $1 million. That's a substantial amount of money. And you can see here that it was 89 in 2021, and it's what? 158 in 2022. That's great. We want to see that grow. And then that collection of 158 customers represents 43% of their total fiscal year revenue. So the next number that you see, ARR greater than 100,000, that reflects the number of customers paying them more than $100,000, which you also want to see going up over time. And that's just 15% of the 10,000, over 10,000 customers they had at the end of fiscal 2022. This is great. So when they say 73% of the increase in 2022 revenue was from existing customers, that's because they have a very high net retention rate. You can see it here, 145%. That's very high. Typically, you'll see that maybe in 120%, which would still be considered good or perhaps high. But that means existing customers are using the solution and saying, wow, this is great. We want to use more of it. Why? Because companies that use this solution save money. And guess what? When you're selling a solution that saves money, that sells even better when you have a recession argument. So looking at the opinions of some pundits out there, this was a comment that we took from an article that I think was from The Fool, and it says, UiPath fell in the first half of March on concerns about rising interest rates, et cetera, and possibly that there's a recession that's pending or perhaps already here. Now, whenever there's a recession, CEOs look to save money. So that's what UiPath does. And when there's a recession, you could argue that their solution sells even better because it cuts costs. And I wanted to touch on very quickly a situation that people may not be overly aware of. So there's the old joke about John in Mumbai, and that refers to when they first started outsourcing customer support functions to Mumbai. They gave everybody a Western name, and it was all quite funny when the guy would answer the phone with a strong Indian accent saying his name was John, and everybody had a good laugh. Well, now it's Rosie in Manila. So when you call Chase and you get a customer support agent, they're all, you really can't even hear an accent. Most of them have a slight Tagalog tang to their accent, but you can barely perceive it. And it's a lot better customer experience. That's just the reality. Well, what ended up happening, it wasn't just a function of customer experience. I worked at a firm, and my job was to move customer support functions to Mumbai. I did that for the first half of my decade-long career in finance. And the second half, I moved operations functions to Manila. And when I was working there, I distinctly remember seeing a breakdown of everybody's raises, and Mumbai, for the third year in a row, this was 5 years ago, had 8% or more inflation. That means everybody got at least an 8% raise. Well, today, that's still going. and the accompanying research piece, I pulled out a quote. It's actually expected to be 9% this year, and it was 8% last year. I recall when we were looking at Manila, we could get 5 analysts in Manila for 1 in Mumbai. So things are getting very expensive in Mumbai, and they're no longer doing customer support functions. They're doing back office functions, a lot of which can be automated. So guess what? When the price of your back office, which we had, I think, around 700 people, and I went to Mumbai and I was asked to lead that office, and there would be a cold day in hell before I led an office in Mumbai, because it's just, frankly, it's not a very nice place to live. But all those individuals are being looked at as an expensive cost center now, which makes RPA very attractive. It will sell even better in a recession, and it will sell particularly well when a lot of firms have back office functions in Mumbai or in parts of India that they're looking at and saying, wow, the costs are going through the roof. So we can either look to do another migration to Manila, or we can look to implement some RPA. So we would expect that a lot of the drivers right now are pushing that 145% net retention rate you see at UiPath. That's high because companies are using the solution and saying, wow, this works really well. And in some of our past articles, you can read about some incredibly amazing success stories of RPA and just how much money it can save firms. So just wanted to conclude this piece to say UiPath appears healthier than ever based on the SaaS metrics that we watch. We think you should be watching as well. Certainly be aware of the big brown bear, because that could potentially be a problem if the riskies decide that on Victory Day, which is coming up here, I think on May 9th, they want to lob some sort of a big weapon over at Kiev. That's going to create a lot of turmoil. So just be aware that there's some potential risk there. And guess what? If the markets fall 25% because something like that happens, we talked about beta, expect UiPath shares to fall 25% as well, or more, because they're closer to the situation than other firms might be. And then when it comes to this, looking at the short-term share price and the volatility and how it keeps dropping, largely ignore that. Focus on the health of the business. In our opinion, the health of UiPath's business couldn't be better right now based on the metrics that we've talked about today. So please go ahead and leave your comments in the comment section. We'll answer them there. Make sure to subscribe to our YouTube channel. I'll put all the research in the description of this video. Thank you very much for taking the time to listen to this video today.